In this video today, I'm going to explain what factors make a stock more likely to short squeeze than other companies throughout the stock market. So, obviously, everyone talks about short as a percent of float, which you can really look up pretty easily. There's a bunch of screens like this one here that will show you the stocks with the highest float as a percent shorted. And here we can see Carvana, 47% of the float is shorted. Lucid, you could see 41% of the float is shorted. And this is important for sure, but at the end of the day, it's not the end all be all. There's actually a lot more that goes into determining the likelihood of a short squeeze, and that's what I'll be covering in today's video. So let's just dive right in. So when I look at short squeeze data, this is the first site that I come to because it gives me days to cover very quickly. And this is another free site that I'll link below. So all I do is I type in the ticker up here, I press short quote, and then it shows me all of this information here. And really the most important info for me is the days to cover. So this 18.9 number here is definitely a significant number, and I'll tell you why. So this 18.9 number signifies that it takes 18.9 days of average volume to cover the existing shares that are sold short. So I'll say that again, it takes almost 19 days of average volume to cover the existing shares that are sold short. So let's say in this situation there are 19 shares sold short, and the daily volume is one share a day. So it's going to take 19 days of average volume to cover the shares that are sold short. Obviously, that just made up those numbers, but that kind of tells you, that kind of gives you a good representation, a good example of how this actually works. So anytime you're looking at shares that are sold short, it's all relative to the amount of volume that a company has in a given day, right? So that's kind of why this number is very crucial to look at. Well, what we typically look for days to cover is a days to cover number over 10 signifies a high likelihood of a short squeeze. So any number that's over 10 signifies a strong likelihood for a short squeeze. Right here, we're at 18.9, which is obviously well above that level, which is, even increases the likelihood of a short squeeze even more. So obviously, this is just one number, so let's not, overblow one specific number. Let's not put it in a vacuum and, make it the end all be all. But with that being said, a days to cover number over 10 is a strong signal that a stock is likely to have a short squeeze. Obviously, there are other factors. So to recap, we went over short percent of float, which in this situation is about 36%. And then days to cover of 19. We went over both of those. So what else is there? And before I kind of dive into a couple more numbers that I want to cover, there are awesome screens that will show you, what stocks are likely to have a short squeeze, and they'll look at all these factors and a couple more that I'm going to cover later on. So this is Fintel's screen here, and it shows me which stocks are most likely to have a short squeeze based on various factors. So we can see Toro here is the number one. We can see Gree at number 5, Getty at 8, and some others, BBIG at 12. So these can be good resources when you're trying to start off on a research path, or a rabbit hole that you want to go down with a specific stock. This can kind of be a good starting point as to what stocks you should be looking into and researching. So another big factor in measuring the likelihood of a stock in terms of short squeeze potential, well, is short borrow fee rate. So this tells me what investors are charging firms to actually lend out their shares. Because when a share is shorted, it's taken from a client and then it's sold, but you're basically borrowing it from that client. So if I'm X institution and I want to short shares, I'll go to Robinhood and say, hey, give me 10 shares of AMC, and then I'll sell them immediately on the stock market, but I still owe Robinhood 10 shares. So in a way, it's like I'm borrowing those 10 shares from Robinhood, and I have the obligation to give them back those 10 shares. In return for lending me those shares, Robinhood gets this 9% fee. So this is an annual rate. So for this stock here, which is Pro Kidney Corp, they have 9%. So they're charging a 9% annual rate to lend out their shares. And when we take a look at the short shares available, this is also something I like to watch as well. So this shows me hour to hour pretty much how many shares are available to sell short, because there aren't an infinite amount of shares. For a share to be able to to be sold short, it has to not have a limit order. It has to not be restricted by the broker. So there's factors that go into calculating this number here, and obviously if you have 0 shares that are able to be sold short, well, that just tells you that shorts are about to run out of steam here. And obviously we had about 15K just earlier today, and as you kind of get closer to 0, it implies that that shorts are likely to be able to be kind of running out of shares to short, obviously, right? If there's 0 shares available to sell short, which was the case for Agree today, it's tough to continue to push shares lower, right? So that's kind of how that works. So if investors aren't willing to lend out their shares, meaning there's no shares sold short, there's no shares being able to be sold short, that is another sign of a stock that is likely to squeeze higher, just based on that pressure there. So the last thing I wanted to cover was fails to deliver, which is basically when you lend out a stock and you ask for it back, you want to go and actually sell it, but the person who actually borrowed the stock from you, they don't deliver you that stock back. So it's basically like creating imaginary shares in a way, because they're borrowing shares from you, selling it at the market price, and when you go to ask for those shares back, well, they don't have it. That is a fail to deliver. So this is something you can find on the SEC's website here, and you can download the zip file, and it will basically show you over the first half of a month, so basically in a 2-week period, on average how many shares, or actually no, in aggregate, how many shares are failing to deliver. And this is also something you could find on QuantQuiver. So this is another free resource which I'll link below. So this shows me basically social media sentiment, which is obviously somewhat of a factor when you're talking about a short squeeze, right? We saw what happened with AMC. We saw what happened with GME. If a lot of retail investors get behind a specific name, well, that could exacerbate a short squeeze, and we saw that in the past. So this Wall Street Best score shows me the kind of social media sentiment, but this fails to deliver score shows it's basically just a representation of the amount of shares that are failing to deliver. So you're failing to actually pay back those shorts. And you can click into that number. And actually how you do that is you just go, you go right here, fails to deliver, open it up. It will open up this screen, and then you could type in whatever stock you want. You can see that total history of failing to deliver. So you can see that the average failures for each month. So in July, there were 12 million shares that failed to deliver for AMC. And in June, it was 4.9 million. In May, it was 1 million. In April, it was 4 million. But what I thought was really interesting here is you want to be kind of looking at the trends, right? So obviously we had that short squeeze in late 2020, and we could see the stock was definitely failing to deliver. 4.7 million shares failed to deliver, 2.1 million shares failed to deliver. Anytime that the stock has had over a million fail to deliver, we've had some type of short squeeze event over the preceding months. And right now, this on a monthly basis, this failure to deliver is actually the highest that it's ever been for AMC just in this current month, which I thought was pretty interesting for shareholders there. So it's not only the specific number of failing to deliver, it's the trend, right? We've seen those average failures increase each month, and we can see here that yes, 1 month, 1 day spikes, were greater than the average or over the month for the current month, but that's not the average, right? That's once you smooth it out for the average of the month. July is this past month is the most failing to deliver those shorts that we've seen in AMC, which I thought was pretty interesting. So, and I just give that example to kind of show you how you can be looking at all of this. So, I know that was probably a bit confusing, especially if you were coming at it cold, but I let me just try to wrap things up in conclusion here. So, short interest as a percent of float, it's likely what you've already been seeing. You can see these screens throughout the stock market, throughout the internet, and this is definitely a good starting point. And then secondly, you want to look at days to cover. A days to cover over 10 signifies a strong likelihood of a short squeeze. Also, you can look at, the recent trends in short squeeze. So every 15 days, we get new updated information for short squeeze data. So, or just general shorts. We'll get it twice a month. And during the last period here, we actually saw a decrease in shorts by 3%. And then there are good screens on Fintel. This is actually a paid sub, so you won't be able to get this for free. But there are a ton of good resources out there that have lists just like this one. So this lists the stocks that are most likely to short squeeze based on pretty much all of the factors that I covered in today's video. So this is definitely a good starting point and a good resource for your start of kind of short squeeze research here. If you're looking to look into a stock that is at a high likelihood for a short squeeze, this is a good list to start from. And then the short shares available. So pretty much the more shares that are available to be sold short, well, the easier it is to short shares, and obviously that's a good thing for shorts. So as a bull, you would really want to see as little shares as possible in that are available to be sold short. That would just imply that companies out there, institutions out there aren't able to short shares because there aren't any shares able to be shorted. So that is obviously something you want to keep your eye on. And like I said, this number can be 0, which is obviously a good thing if you're a bull and you want to kind of see a short squeeze. And then failures to deliver is obviously a big thing for a company. And this kind of tells you how much fake shares there are out there. Weirdly, I kind of throw that around loosely, tongue in cheek of a bit here, but basically all you need to know is the more failures to deliver, the stronger likelihood it is for a short squeeze. So that's why I think this screen from Quant Quiver here, which gives you the kind of breakdown of social media sentiment and then also the fails to deliver score, I think in combination that's a pretty good those are two pretty good metrics to be looking at when you're trying to look for a stock that is likely to short squeeze. So those are the factors that make a stock have a stronger likelihood to short squeeze. Obviously, you could have all these numbers line up and the stock still may not squeeze, or it may squeeze once your calls expire, right? So this isn't the end all be all. Obviously, do your own research in D&D, but generally, this is the foundation for short squeeze research. These are the main metrics every person, every financial analyst is looking for when they're looking at a stock that has a high likelihood of a short squeeze. So with that being said, I hope you enjoyed the video. I will end it there.